Hello everyone. So let us start the discussion. Till now we have the basic introduction about the term valuation, about the term intrinsic value, the going valuation, the liquidation valuation. Let us take the discussion ahead and move one step forward with our discussion. Let's start. So first of all, since our full topic is dedicated toward the term valuation, our full topic is dedicated toward the valuation, so isn't it that we should give the heading first of all to understand in detail that what valuation is all about. Okay, let us give the heading valuation. See, at the end everyone comes to the conclusion of the valuation. Means I give an example, a TCS firm. Okay, they come to a news channel for the purpose of interview. What they say? They say that their profit margin increased. What they say? They say that their profit margins improved. Clear? What is the end outcome of this? The end outcome of this is the valuation. The value of the TCS increased. Valuation of the TCS increased. This is the outcome of the term profit margins increased. Similarly, if someone will say that during this period their sales improved. Clear? If their sales improved, then what is the net outcome of it? That their value increase. So at the end everyone comes to the conclusion about the valuations, whether the value of the company increased or decreased. There is some event, these are the events, and because of which their valuation increased. Clear? Similarly there can be some other events. Like they can say that their cost of input increased, but their sale price is intact. Means there is no change in the sale price. I give you an example, airline companies, their raw material cost, that is fuel, their price of the fuel is rising, but they are not being able to increase the cost of the flight, the fare of the flight, because if they do so, people will shift to the other mode of transportation, that is railways or their own car. So they have to remain intact with the pricing of the tickets, but their cost of input rise, because of which what will happen? Their profit shrink, and if the profit will shrink in the coming year, their value will decrease. Are you getting the point? At the end everyone is coming to the term and called valuation. Means after of all the story, what is the end result of all that? On the valuation. This is what everyone trying to understand. Clear? Now apart from that, I have also given you the understanding about the going concern value and liquidation value. Clear? Now can you tell me which one is greater and why? So the answer is that the going concern value is greater than the liquidation value. Always. Means if I talk about a company who is going ahead, and there is a company who is going to close down soon and they will sell their assets. Clear? They will sell their asset, but there will be someone who is going to buy the asset. There will be someone who will buy the assets, but still why the value of this company is less than the value of this company, even considering that they both are from the same industry, they both have the same asset, everything is same. Clear? And if over here Mr. X is selling the company to Mr. Y, then definitely Mr. Y is feeling that there will be huge growth in the company. In future he'll be able to make good return out of it. Clear? So why the value of liquidation is always less than the value of the going concern? That is what my point here is to explain you. See, these are all not written in the book, but for the knowledge perspective we need to understand it. So in the going concern, you will take the sum of all assets and value them. But in case of liquidation, you divide the assets and then you value them. Means there are different assets, you take the value of each asset separately. I give you a small example and you will understand. There is a computer. If you will find out its valuation, and there is a suppose a computer which you are selling. So you are selling your keyboard separately, you are selling your mouse separately, you are selling your motherboard separately, you are selling monitor separately. So when you are selling everything separately, the synergy among them all will deteriorate, because over here if you are buying a computer, you can take a better use of it rather than buying only keyboard or buying mouse or buying motherboard. Clear? So that's why over here the value is greater, because there is a synergy between the CPU, the mouse, the keyboard, the motherboard, and that will increase the valuation of the computer. So this is the one reason that the going concern value is always greater than the liquidation value. Apart from that, there is one more reason. There is one more reason. The reason number 2 is that when you are selling an asset, you are selling it in a distress situation. You are selling it at a distress situation. You have to sell it. You don't have any other option, because you have to pay to your creditors. They are standing outside your home. So you have to sell it immediately. And when you have the urge to sell, people will demand and they will give you a lower amount of money, and you have to adjust in that. Means, suppose you have a computer or a laptop whose worth is 48,000. Clear? But a laptop whose worth is 48,000, you have to sell it immediately. You will sell it at a lower amount, so that it can be sold easily and you can get the money as soon as possible. You can sell it easily and you can get the money as soon as possible. These are the two major points which I want you to understand. Clear? Apart from that, I have given you one understanding as well, that the current market price is 540. This is the current market price. This is the real intrinsic value. Suppose it came out to be 500, and according to your model, value came out to be 480. So what you personally feel is that according to your model, the price of the share should be 480, but it is trading at 540. So according to you, it is overpriced by 60 units, overpriced by $60. This is what you personally feel. Write down. I personally feel that these comments are very important. If you are writing down it in your notes, and when you will revise, it will help you a lot. Okay, I personally feel that prices are overpriced by $60. Clear? So I should short sell. This is the first point. But write down, but real mispricing is only $40. Real mispricing is how much? Only $40. Clear? So what I want, being an analyst, I know that there is model mismatch. There is some error in the model. My model must have given me 500. Because this is the real mispricing and this is the model error. This one is model error and this one is real mispricing. So the whole topic of equity is about getting this 500 from my model. What I want that my model will give me the valuation of 500. So that gap of 20, I want to remove that. I want to improve my models. I want to use different models which can lead me to come to 500. I want to use different methods. Okay, sometimes I use fundamental, sometimes I use technical, but what I want is to understand that what is the real intrinsic value of the company, that is 500. So the whole discussion is about reaching to that real intrinsic value, and from there you will compare yourself with the price, that whether it is overvalued and undervalued. Once you got that, then you will be able to take the buy call or you will be able to take the sell call. Clear? I have given you a basic introduction of what we have studied with a better finishing touch. Clear? Okay, so while doing the valuation, write down, while doing the valuation, I have two methods. I have two methods to actually value something. One is to find out its intrinsic value with the help of the fundamental model. With the help of fundamental models. One is the dividend discount model, okay, and another one is to compare it with the similar company. Compare it with similar companies. Clear? Means if I want to find out the value of the TCS, I'll compare it with the Infosys. Clear? And then accordingly I'll adjust for the beta and other relevant factors. So now, if you want to do the valuation process, there will be definitely some steps. There will be some steps. So first of all, if suppose you are doing the valuation of a company, say TCS, so you need to understand the business. You need to understand the business of the TCS. You need to understand the business of TCS, that what business TCS do. They make softwares, they develop websites, they give consultancy, okay, they also work on the infrastructure, they work on the IT infrastructure, more specifically they work on the security systems. So all these things are the business of the TCS. Clear? Also we need to understand about the industry, that how the IT industry is performing. We also need to understand how the economy is performing, whether there is any type of recession or not, okay, whether the economy will be at boom. Because if the economy will be at boom, if the economy will be at boom, then its fundamental will increase, they will post high sales, they will post high profit. But if there is a recession, then the sales will reduce and the profitability will also reduce. Clear? Why I am saying so? Because the next step after this is to forecast financial statements. Write down forecast financial statement. Forecast financial statement means what will be its sales, what will be its expenses, okay, how much debt it will take, what will be the component of the interest, how much tax they will pay, how much dividend they will pay, and after doing all that, how much the value of the equity, how much the value of the equity will rise, how much the value of the equity will rise. Clear? So first step is to analyze the business, second is to forecast the financial statement. Now once your financial statement is forecasted, now you will come to your model, your forecasting model. Suppose you have forecasted your dividend, that what will be the next year dividend, so you will use a dividend discount growth model. Clear? And based on that model, they will provide you a value. So means what? Your forecast will become the valuation. And based on that valuation, you will take the decision that whether you will buy the shares, you will sell the shares, or you are going to hold the shares. Clear? Whether you are going to buy it, whether you are going to sell it, or whether you are going to hold it. Again I am telling you the 5 steps. It starts with understanding the business. Second, you need to forecast the financial statement, come to the valuations, then use it for the purpose of taking the business decisions. Again, business understanding, forecasting the financial statement. Third, you need to select the appropriate model, which model you want to use, and then you need to convert the forecast into the valuation. Means based on that valuation model, you will come up with some value, and then you will take the decision that whether you will buy the share, sell the share, or hold the share. Okay, so now once you got the value, what are its applications, or what are the uses of the value which you have actually found out using your valuation models. So there are basically 8 applications. Write down number 1, stock selection as to which stock you want to buy, which stock you want to sell, which stock you want to hold. Reading the market, Write down point number 3, value of corporate action. Means if they are going to suppose announce the dividend, or if they are going to announce split, if they are going to announce the buyback, so what will be its impact on the pricing of the share? So impact of, see, you don't have to mug up these points, these all are very natural. Okay, impact of corporate action, corporate action, impact of corporate action. Write down next point, point number 4, fairness opinion, fairness opinion. Next, planning and consultancy, planning and consultancy, planning and consultancy. Point number 5, planning and consultancy. Write down point number 6, communication with analysts and investors, communication with analysts and investors, communication with analysts and investors. Write down next point, valuation of private business, valuation of private business. If there is a private business whose value is not there in the market, it is not trading in the market, then you have to use some valuation method to actually find out its value. And the last one is the portfolio management, last one is the portfolio management. So the point number 1 is totally clear, that stock selection means I am going to choose which stocks to buy which are undervalued, okay, whose intrinsic value is greater than their current market price. Now the next point is reading the market. Reading the market means we all know that information is available to everyone, and that is incorporated in the price, whether the earning growths, whether the buyback, whether the split, or any setting up the new infrastructure by the company, setting up the new plant, or opening its outlet in some other countries, or setting up the new product line. Every information is there with the public, and that is available in the share price. But now, being an analyst, I'll not trust what everyone thinks. I trust my model. I'll give all that input to the model. Model will give me the value, and I'll compare that whether the value given by my model is equal to the current market price, which is already incorporated all the factors. If they are equal, then it's okay, they both are fair, they both are correct. But if suppose my value comes at 450 and real value comes at 400, that means what? Stock is undervalued and I should buy it. Means people are not giving the right weightage to the information, that because of which it should rise to 450, but at present it is not rising. But when the real numbers will come out in the market, when they will launch the new product, when their sales will come and it will impact the profit, the value of the company will rise to 450. It's not today, but later on definitely it will come down. Okay? Now the next very important point, okay, which I should tell you, let me put it on here. Currently the stock price is trading at 450. Your model is showing that the share price is 480. Clear? So you see that the share is undervalued by $30. Clear? What you will do? You will buy it. Clear? But suppose your holding period is 4 months. Suppose your holding period is 4 months. Clear? You need to check that whether in 4 months the price will correct itself or not, because sometimes it can happen that in correcting itself it can take 6 months. In correcting itself it can take 6 months. Clear? But your holding period is how much? The investment holding period is only 4 months. But in order to take this $30 advantage of mispricing, you have to wait for 6 months. So will you invest in this stock? No. Means even if the stock is undervalued, but you know that it will not correct itself in the investment horizon, in your investment horizon, you will not invest in that stock, because you won't be able to enjoy that $30 under pricing in the script. Very important point. So we are done with 2 points. One is the stock selection over here, and another one is the reading the market. Third one is the impact of corporate affairs, corporate actions like split, buybacks, setting up the new plants, dividends, corporate tax, everything. Now these also include some of the points like mergers and acquisitions, if there is any arbitrage possibilities or not, if there is any management buyout or not. So these all are also corporate actions and I need to identify that if my company X is acquiring company Y, so whether my value will increase or decrease. If it will increase, I'll buy it. If it will decrease, I will sell it. Clear? Now the next point is about the fairness. It is also the same, that whether the prices of the shares are fair or not, whether they are in line with the intrinsic value or not. Now the next point is about the planning and consultancy. Means you plan that which shares to buy, which shares to sell, and sometimes you are in the consultancy role to some firms where you have to tell them that whether this deal is good or bad, whether you should buy this particular script or not. So based on that, you are going to consult them, you are going to plan the future for their portfolio. Wealth management is also the part of it. Clear? Next is all the communication to the analyst and the investors. Sometimes you see that on the news channel they show like that in 6 months the price of the TCS will be around 3700. Okay, in 4 months the price of the Infosys is around 1900. In 12 months the price of the Tata Motors is around 600. So this is what the communication by the top companies to the analyst and the investor, that what value they are looking in these particular stock, in these particular companies. Clear? Private business valuation is about identifying that what is the worth of a private company, because they are not trading in the market, information is not public, nothing is available. Okay, even the comparison will also be very less, because in private company they are very diversified. Okay, they have the different types of business, very difficult to identify or to compare peer to peer. Means if there is a private company and comparing it with a public company, it will not make sense. Clear? So it is very difficult to value the private company. So for that we have different methods and different models. Clear? That we'll study later on too much in detail, but the point over here is about the applications of valuation. Means what are the use of valuation? Stock selections, reading the market, even portfolio management. You need to create a portfolio for your client, and there also you need to decide which stocks to buy, which stocks to sell, how much to hold, what is the holding period. Clear? So I'm not entering into the detailed discussion of the portfolio because we have done it over there. Clear? In the portfolio section. The point over here is those 8 points, that is about the uses of the valuation. So let us keep this much in this lecture, where I have introduced in the beginning few topics which we have covered earlier, just a touch upon on that, and this new topic which I have covered in this lecture is the application of the valuation, and also the process of the valuation is also discussed in this lecture. Clear? So make sure that you will revise your previous topics and solve questions so that you can move ahead. Thank you.